I'm Jill Ford, Head of Communications here at the BIS, and with me to answer your questions today are our General Manager, Augustine Carstens, our Deputy General Manager, Luis Pereira, our Head of the Monetary and Economic Department, Claudio Borio, and Economic Advisor and Head of Research, Shin. I'll hand over first of all to our General Manager, Augustine Carstens, for some short opening remarks. Thank you, Augustine.
Thank you very much, Jill, and good afternoon, and thank you very much for joining us for this media briefing on the 91st BIS Annual Economic Report and our annual report. As you know, the Annual Economic Report is our flagship publication. Every year, we aim to tackle some of the big issues facing our central banking community. This year, we have pre-released a special chapter on central bank digital currencies, which open a new chapter for the monetary system. CBDC are an advanced representation of money for the digital economy, grounded in the trust which accrues to the central bank. They offer in digital form the unique advantages of central bank money: settlement, finality, liquidity, and integrity. The other special chapter in the report addresses rising income and wealth inequality, which has been exacerbated by the pandemic. It analyzes the structural causes of inequality, including globalization and technology, and monetary policy's role in mitigating them. Long-term trends in inequality result from structural forces that are beyond the reach of monetary policy. But central banks still have a role to play. High inflation and economic and financial instability amplify inequality, and central bank mandates are all about fighting such instability. The economic analysis at the heart of the 2021 report looks at the recovery from the pandemic and the challenges facing central banks in the next phase. The global recession was deep, but ended sooner than expected, aided by considerable policy support. Still, with the pandemic far from over and variants still at play, we are seeing a very uneven recovery, and the global outlook is uncertain. The next stage of the pandemic will involve different but no less formidable challenges. As the rollout of vaccines and improved treatments help countries manage the pandemic, its enduring consequences for economic reallocation and work practices will become increasingly apparent. The central scenario is for the economic recovery to continue, albeit at varying speeds across countries. But the report considers two alternatives. First, very large fiscal stimulus and the drawdown of accumulated household savings could deliver stronger growth and higher inflation, resulting in a substantial financial tightening. And second, growth could disappoint and business credit losses mount if the virus is not controlled. Business insolvencies could rise and policy space would be stretched, especially for emerging market economies. Further out, the key task will be to lay a solid foundation for the recovery to allow for gradual policy normalization and to manage any tensions that might arise between fiscal and monetary policies. The historically unprecedented starting point complicates normalization. Government debt to GDP ratios are equal to or higher than after World War II, while nominal interest rates have never been so low. Most important is to adopt policies that strengthen sustainable growth. Structural reforms that promote a vibrant, flexible, and competitive economy are essential, and encouraging resources towards more productive sectors in the post-pandemic world. So with these introductory remarks, we would be more than happy to entertain any questions you might have. Thank you very much.
Thank you very much, Augustine. So for those of you that have joined us late, and we've just noted your arrival, and just to remind that the media briefing is embargoed until 2 p.m. Tomorrow, that's Tuesday, the 29th of June, Central European time. So to ask questions, please raise your hand and you can ask your question into the room. Put your question in the chat, or you can email press@bis.org. So while we're waiting for the hands to raise, I'll just also say that we'll take as you know, we pre-released chapter 3 last week. So if there's any questions on the CBDC chapter, I'll take those towards the end of the briefing to give us time to answer the questions on chapter 1 and 2. So just give you a moment to either type in your question or to raise your hand. So Paul Davies from the Wall Street Journal has raised hand. Paul, please come in.
Yeah. Hi. So a couple of questions related to the outlook, and particularly the second scenario. I just wanted to know, how seriously we should take the second scenario there of higher inflation, and then kind of, I guess, a couple of sort of points related to that. I mean, internationally, do we need to be concerned about a kind of feedback between economies that could lead to a slower build-up in more sustained price pressures that might be more difficult to tackle by individual central banks? And then the other things about the role of inflation expectations. Do we think central banks have the right kind of influence, or as much influence as they want over expectations? And is that a trickier aspect? Is that going to be a trickier aspect to deal with? Thank you.
Well, thank you very much, Paul, for your question. The second scenario is the one, I'm not absolutely sure if that's the one you're referring to, but it's the one where we have more problems with containing the pandemic, and therefore there probably would be less of an inflationary pressure, and probably more problems in terms of economic recovery. Inflation, in any case, it's an issue that we should take very seriously, and central banks are taking it very seriously. The central scenario contemplates a higher inflation, but it doesn't go out of control. And here, what plays a major role is the fact that many of the increases in the price level that has been affecting measured inflation has been temporary factors, base effects, the relative price increases, adjustments in prices that are related to supply chains, and those tend to disappear after a while. Therefore, they don't really affect inflation. Here, and this relates to the very important part of your question about inflationary expectations. What is important here to do and to make sure, central banks need to make sure, is precisely that inflation expectations are anchored over the relevant period. Now, of course, if we look into years now and we're talking about the annual inflation, yes, inflation expectations have increased, but the inflation expectations that go beyond a year and more, they have not adjusted. So that tends to confirm what many central banks are saying, and we join them in thinking that the increase in inflation that we have seen recently is temporary. Now, at the same time, it really behooves central banks to be watching very, very careful inflation expectations, and if they become unanchored, then they would have to act, and precisely their actions would be in line to keep those inflation expectations well anchored. And yes, they have the instruments to do that. I mean, certainly the traditional monetary policy instruments are there, interest rates are there, other balance sheet instruments are there. we are not, in particular, if the concern is higher inflation, there are no limit to the use of the monetary policy instruments of the central bank, which is the contrary when inflation is falling and we have the problem of the effective lower bound. So I hope with this I answered your question.
Thank you very much, Augustine. The next question is from Arantxa Iniguez of EFA. Arantxa, can you call in your question?
Hello.
Hi. Please ask your question.
Government debt is at levels not seen until the end of the Second World War, but the debt service cost and interest rates are very different levels. Now the service cost is even negative. Could you explain a little bit more about this situation? Which kind of similarities you find in that moment, 1944, 45, and our currently situation?
Of course, and I will ask here also my colleague Claudio Borio to pitch in, because this is a very interesting, important question. Yes, you're absolutely right. Right now we're in a circumstance where in many countries interest rates are very low, or even negative, and certainly growth is higher than interest rates. So that helps in terms of establishing debt sustainability in the years to come. But the real issue is that this probably will not last. As we were referring in the previous question, there seems to be scenarios where inflation might be higher. Certainly, we believe that there is a good opportunity that in the medium term, inflation will be closer, if not at the objectives of the central banks, and that will tend to correct interest rates. If we look where interest rates were in the mid-90s, in a scenario not that different that we would have once we have, let's say, a more normal economic environment after the pandemic, given the very large amount of debt, the debt service load would be at a pretty much all-time high. So it doesn't take that long to move from a very comfortable situation to one in which the burden becomes more complex. So I think more than anything, what we want is not to get surprised, and precisely for the excess debt burden, for it not to become a major drag on the economy. But I want to see if Claudio would want to complement this answer.
Well, thank you, Agustin. I think you've almost said it all, but just to go back to one point you made, Arantxa, that's about similarities with 44, 45. Well, clearly there are not that many, given that we fortunately are not coming out of a war, unless you are thinking of the pandemic as a kind of war. This is a long-term trend that started in the 1980s, and we could then try to examine why it happened, but it's a confluence of circumstances. One big difference between 44, 45 and now is that after the war, there was a lot of pent-up demand, and one had to reconstruct many economies from scratch, and that provided quite a bit of room for additional growth. I think the complication nowadays is that we're not in that situation, and as we say in the annual economic report, it's absolutely critical to improve the trade-offs to raise growth, and we don't see any alternative to that, but to actually going through structural reforms and growth-friendly fiscal policies. And this is clearly going to be tougher than it was after the war. One other point that I would like to emphasize is that, as we say in the report, Sometimes it's common for people to say, well, there is no problem with government debt because interest rates are low. But as Agustin said, we don't want interest rates to remain as low as they are. It's important that real interest rates in particular are positive so that we have a healthier economy and capital can be allocated more effectively.
Thank you very much, Claudio. So I encourage everybody, if you want to raise your hand to ask a question, please raise your hand. If not, put your question in the chat or email press@bis.org. So we just keep an eye out and just see if there are any more raised hands. There's a raised hands from Mark Jones from Reuters. Mark, if you want to... We can hear you. Go ahead, Mark.
Hi there. I just wanted to ask a couple of things. The idea of the green recovery is obviously very important to all of this. And how inflationary do you see that potentially? You know, and also there's this idea of secular stagnation coming, and is there a view on that risk as well included in this report?
Well, let me take the aspects related to your question to inflation, and then I will give the floor to my colleague Luis Pereira to address the issue about the green recovery. Again, in particular in the U.S., we're seeing a rapid inflation, but as we already mentioned, this is related to transitory factors. We believe that there are very important underlying situations that are more fundamental than the ones that explain the increase in inflation, that let us believe that this hike is transitory. Let me emphasize them now because I already emphasized those transitory factors. One is the fact that we have still a lot of slack in the labor market. The participation, the level of participation is low, and we don't see much pressures on wages yet. Then there are other factors that have been helping inflation to stay at relatively low levels over the last decade or so, which has to do with globalization, has to do with technological change, and I think that those factors will continue to be there. In addition, it's very likely that, as we have seen, that the pandemic has accelerated some of these technological changes, and that by itself exerts some pressures on some margins in some sectors. For example, e-commerce has increased dramatically during the pandemic. It's not going to go back, and that puts more of a lead to more of a lead to inflation. In terms of the recovery itself, the recovery itself, we believe that, I mean, it in the very short term is still very, I would say, dependent on the evolution of the pandemic. If things are kept under control, vaccination continues, and we don't see aggressive or adverse mutations, it's very likely that the recovery will continue, and therefore we will see a sort of a typical recovery where the economy is growing fast. There's some inflation, but it's not out of control inflation. In the short term, if there were a very negative development in terms of the pandemic, we could have higher prices and lower economic activity. But that I would say would be a relatively short-lived phenomena. So I mean, I think that I think that under the central scenario, the most likely scenario, inflation in the years to come should not be a major issue. Now let me give the floor to Luis Pereira.
Thank you, Agustin. Mark, I think this is an excellent question. Yes, indeed, the idea of fostering a recovery that is as green as possible is in the minds. You can see some of this in the plans that have been announced, for example, in the infrastructure recovery in the US, but also in Europe, but also in Asia. The idea is that the fiscal stimulus can target investments that have a lower carbon footprint in the long run. And you can, in a sense, kill two birds with one set of policies. You address, of course, in the recovery activity and employment, and you also, at the same time, address the carbon footprint by fostering new investments, new research. And in this issue, finance has a very good role to play, green finance in particular, because it is through this that you can sort of be in a position to make the transition to a high, to a lower, even a net zero economy. So one of the opportunities that we have, it is not easy. It requires a coordination between many actors. This is not something that the central banks themselves will do it alone. It requires coordination with the private sector, with, of course, governments, but it's to seize the opportunities of the recovery to identify what are the best projects that would at the same time accelerate employment, accelerate activity, and accelerate the reduction of our carbon footprint. You have many ideas in some of the reports that have been recently released by the G7 and the G20, and at the BIS, we are working on this. You might have seen the last Green Swan conference that we hosted. This was one of the big topics that we discussed here in Basel. And with the Network for Greening the Financial System, that is the group that coordinates central banks in this matter.
Thank you very much, Luis. And we have another call from Li Wei Wang from Caixin. Li Wei, if you want to come in with your question.
Want to tap your thought on role of central banks. Augustine mentioned there is a chapter on distributional effect of monetary policy. I understand all the arguments there. To some, they would think monetary policy after, especially QE after the financial crisis, sort of worsened the inequality situation. Do you think is the effect an unavoidable consequence given the lack of fiscal and structural reform policies after 2008? And does it make the situation a bit brighter given the we have more fiscal efforts in US now? And perhaps a related sort of a blue sky question. For central banks' effort in the green area, I would sort of contrast it with other efforts. For CBDC, these tech efforts, this might be a defensive act from central banks to fend off, say, tech giants or say stable coins offense. But for green efforts, will that may that be an effort by central banks to mitigate the negative image in the wider society? Is there an element like this? Just want to tap your thoughts. Thank you.
Thank you very much for your questions. Well, let me start with the first question. I think the core message that we sent in chapter 2, the one that relates to income inequality and monetary policy, is first that income inequality in the medium and long term is not a monetary phenomena. Given that monetary policy depends on asset prices and on interest rates adjustments for the transmission, in the short term, it might have some impact on income distribution. and oftentimes is towards making it worse. Now, the question that we ask ourselves then is, should this be a good reason for central banks not to use its monetary policy instruments? And in particular, if we are just judging from the income distribution point of view. And the answer is that if central banks do not use their instruments, the consequence of financial instability, inflation instability, or recessions or unemployment would make income distribution even worse. So we believe that that even though in the short term monetary policy might have a negative impact on income distribution, it sets the conditions for a more stable economy, a better performance of the economy, and at the end of the day, things would be better. I mean, that doesn't mean that central banks cannot do anything positive about income distribution. In general, just by preventing economic instability, they do a major contribution. And in addition, there are other activities related to non-monetary hats, like, for example, in terms of supervision, regulation, and whatever they can do to increase inclusion and reduce and enhance efficiency of the payment system and avoid undesirable practices in the financial system. So I think central banks can play a very constructive attitude, can play a very constructive role with respect to income distribution, but that doesn't take away that in the short term, some of their actions might affect income distribution. And the second question, we really cannot, we didn't understand it very clearly. So
may I suggest maybe we get some clarity? I think it's about prioritization of CBDCs, but maybe we can come to the CBDC question towards the end. We have a number of other people waiting. So if that's okay, Liwei Wang, and we'll come back to your question towards the end. Going back to the phones or the lines, could I ask Johanna Treck from Politico to give your question, please, Johanna?
Yes, thank you very much. Can you hear me?
Yes, perfectly.
Fantastic. Thank you so much. I have a question on your on the box on labor markets and the reviews of monetary policy frameworks. Again, on inequality, you spell out here how some central banks have moved towards average inflation targeting, hoping that that would reduce inequality, but you also spell out the risk that, you know, over the long term, we could have new imbalances build up and increase inequality. So do you have any takeaways from the experience so far? Is average inflation targeting, does that reduce inequality or does it not?
Thank you, Johanna. I think Claudio, maybe if you could answer this one.
Yes. Well, thanks for the question. As we say in the annual report, annual economic report, and this is important to bear in mind, there are trade-offs, and central banks are aware of these trade-offs. And the trade-offs have, between the short run and the long run, have been exacerbated by changes in the nature of the business cycle, going from a situation in which it was basically very simply inflation going up, central banks tightening, and a recession following, to a situation in which it's nothing much is happening to inflation, therefore to monetary policy tightening, and a lot is happening to credit expansions then turn into contractions. So this is raising what we call intertemporal dilemmas. And this applies to any framework which targets inflation, and therefore it also applies to average inflation targeting. In that sense, there is nothing specific about average inflation targeting. So you have a trade-off between the short run and the long run. Central banks are aware of that. Where they position themselves exactly will depend on their mandates. some central banks have financial stability on the monetary policy side explicitly in their mandates. It will depend on circumstances, and it will also depend ultimately on views about how the economy works. But this is indeed a delicate balance. And as we emphasize in the annual report, in the annual economic report, it's such a delicate balance that one needs the support of other policies in order to improve the ability of central banks to carry out their mandates without incurring these risks. And we emphasize the role of micro and macroprudential policy, the role of fiscal policy, and also the role of structural policies.
Thank you very much, Claudio. The next question also, I think, relates to central bank mandates from Marcus Fruhauf of FATS. He asks, are central banks still independent enough to raise interest rates in regard to their high volumes of government bonds they have purchased? Augustine?
Yeah, I mean, I don't see any issue there. I think that something that I think is extremely relevant here is that central banks have purchased those government bonds in line with their mandate, and in a way they have been they have operated there precisely because they have not had the opportunity to reduce interest rates further. Therefore, there is always a very close interaction between their quantitative easing transactions and their interest rate policy. So I don't see any restriction there, either legally nor also from the attitude of the central banks. In addition, and this is an argument that we make in the document, some of the government securities that are other type of assets that central banks have are in their central banks that pay reserves, and yes, that is something that eventually will need to be taken into account. But more than anything, this has to do with the need to start normalizing fiscal policy. But I don't think that this will be a restriction to either affect the independence of central banks or their willingness to use interest rates as a monetary policy instrument. As a matter of fact, there is a very close relationship. No, I mean, the independence is precisely the ability they have to use their instruments when they're required. And at this stage, I don't see that being compromised at all.
Thank you, Augustine. I can see a few raised hands of people that have asked a question already, so just want to give an opportunity for those that haven't asked a question yet to ask a question or raise your hand or send the email and send it in chat or by email. So just give a moment, just ask anybody that hasn't had an opportunity to raise your hand. Okay, then we might come back. I think Mark Jones, you've raised your hand again. So Mark, you're back on. You want to ask your question? Mark Jones.
Hi, can you hear me?
Yes, perfectly.
Great. Just a quick question on the emerging market section in the report as well. And just an observation really that we've seen quite a few emerging markets already raising interest rates, including your own former central bank, Mr. Carstens. So is this response justified at the moment? And I guess the other question is, if we do see this higher inflation regime, how big is that risk of a taper tantrum, and what advice would there be for emerging market central banks if we are to see those tightening of conditions? I mean, what do they need to get in position to prepare themselves?
Well, some emerging markets have been have faced the need to increase interest rates for a variety of reasons. One is that they tend to be affected more from commodity prices than advanced economies. and given that commodity prices have increased, that has generated more inflationary pressures, and usually inflationary expectations in emerging markets are more sensitive to contemporary inflation than in advanced economies, so that they need to be, I would say, more agile in terms of adjusting their monetary policy. In addition, given that the prospects for growth in those economies and also their fiscal and monetary policy space, and also the progress in terms of vaccination that have generated some pressures in some cases in their local currencies, and the depreciation on the exchange rate has also generated inflationary expectations, and therefore to keep those inflationary expectations anchored, they have faced the need to increase their interest rates. So I see that is, you know, that's a healthy response. I don't think these increases will affect substantially their capacity to renew growth, given that they're also starting at a from a very low level. In terms of the risk of taper tantrum, well, I guess what you refer to is the risks that higher or tighter global financial conditions represent for emerging markets, and yes, they need to be watchful about that. I think that by and large, emerging market economies are better prepared to face a circumstance of tighter global financial conditions. When you refer to the taper tantrum, the emerging market economies that suffer the most there is the ones with current account deficits, very high current account deficits. We don't see that today. I think also many emerging market economies, at least from the sovereign point of view, they don't have a very weak situation from the point of view of external indebtedness. They have a lot of international reserves. So I think that using their instruments, they should be able to navigate this safely. Where there is more risk is probably with some corporate debt, because emerging market corporate debt increased really, really fast. And at the same time, there has been an uneven recovery. So the difficulties might be there, but I think by and large, certainly they will face a more challenging time, but they should be able to handle. And what do they need to prepare themselves? Well, I think the main challenge emerging markets have is the fact that growth has not been that stellar since since 2015 and so on. China, if you take China away, emerging market growth has been suffering. So I think that they need to enhance growth-friendly structural reforms, and also redirect spending to infrastructure so that they become more competitive. So I think the challenge is more growth at this stage.
Thank you very much, Augustine. So looking at the questions here, not sure that we have any other raised hands or emails in. So I suggest if there's any questions just on chapter 3, we could circle back to those. Li Wei, we've been trying to get some clarification, but if I may paraphrase, I think your question is about, whether green or whether CBDCs are a priority for central banks at the time, or both. So Augustine, any particular response in relation to that?
Well, given that interpretation of the question, I think both are challenges, and I don't think that I think at this point is not one or the other. I think both of them come at different different speeds. I think also they address different things, or the two issues affect central banks in a slightly different way. CBDC is very close to home. I mean, CBDC, you have it in the name, central bank digital currency. So that's very close to the central bank. So of course that has to be a priority. Now, green, given climate change and so on, the challenges that the world is facing, central banks certainly have to mind that. And yes, in the context of their mandate, there are issues that they can do about it. But I would say the difference with respect to central bank digital currencies is that in terms of green finance, even though they play a very important role, it's hard to say, it's hard to make the point that they play a central role. No, I mean, I think they play a very important supportive role. They should pitch in sync with their capacities and add themselves to major efforts that need to take place in the rest of the economy. So I would say the institutional arrangement and the mandates of the central bank puts different type of pressures on central banks with respect to these countries. But I would say certainly we are not at the point where we can ignore any of them. I mean, yes, green is important. Yes, central bank will be involved with green issues, but with central bank digital currency, well, there could be no CBDC if there is no central bank involvement.
Thank you very much, Augustine. I hope that answered your question, Li Wei. Paul Davies has another question and a raised hand. So thanks very much, Paul, from the Wall Street Journal. His question is, how seriously do we need to take the risk of the higher growth, higher inflation scenario?
Well, I mean, I think that we need to take it seriously. I mean, it's a positive. It's not the central scenario, but yes, it's a possibility, and the central bank should be aware of it. And I think central banks are in that channel. I think they're taking it very, very seriously, and that's why they're evaluating. They are evaluating developments to see exactly in which scenario we are. I think there are some uncertainties that could produce or could increase or not the possibility of the scenario. One is you know, to if we continue and we can declare victory in the pandemic relatively soon. But it also has to do, the other major aspect has to do with the excess savings that households have accumulated, where the uncertainty is how fast would they reduce those savings. And if it's very, very fast and the fiscal impulse continues at very rapid pace, well, that might generate a much higher inflation. Again, even if there are inflationary pressures, then the issue would be then the priority would be then to have inflation expectations anchored, and that would call for monetary policy action.
Thank you very much, Augustine. And Paul has just typed us in, I suppose, a second part of the question about, is there a ceiling on how high interest rates can go in a country? He says, for example, like the US, without causing distress to financial markets. And says in the US, for example, something that could be as low as 2.5 or 3. Something you want to add there?
Well, I mean, I think it's this is a very important question. I honestly don't think that that we can be as precise as putting a range to it. I would say that given the very low real rates of interest, I mean, I think there is a healthy space for interest rates to increase. Now, the other key aspect is why do you end up with higher interest rates? And I think that makes a major difference in terms of financial stability. If interest rates increase due to much higher growth, and that improves the payment capacity of people, I don't think that this should be a source of instability. I also think that what needs to be taken into account is that some financial stability issues, or the most pressing ones, are being taken care of. And I think in this line, the work that is being done today in terms of making non-bank financial intermediation regulation tighter addresses probably the aspects that today could be more vulnerable to a sharp increase in interest rates. I mean, as things are today, I think that we could have an increase in interest rates without much financial stability issues.
Great, thank you very much. The next question is from Mark Lambrechts of Les Echos. Again, looking, I suppose, towards the future and for our views on the stock markets, do we still see some overvaluation and certain dangers of exuberance? So I think maybe, Claudio, do you want to take that one? Great, thank you.
Well, thank you for the question. I think that throughout last year or so, in our quarterly reviews, and again in the annual economic report, we do mention that we see signs of exuberance in financial markets, given the background conditions. That's true in stock markets, although not uniform across the world. Personally or institutionally, I think we're more concerned with what happens in credit markets, particularly corporate markets, and what might happen in housing markets, in house prices. I think that if you look historically, falls in the stock market are not as important as dislocations in these other two markets when it comes to impact on the real economy.
Thank you very much. I think that might have been the last question that we had. Just checking to make sure we've captured everybody and to give you a chance to send in any final questions before we wrap up. Just watching for raised hands. I think we are all done. So just wait for any. Oh, Liwei Wang, I think, are you coming in with a, can you ask the question? If we give you the audio.
Thank you, Augustine, for your last remark. That's very helpful. So, question for Hyun Sung, following last week's CBDC briefing. So, as Benoit mentioned, the point on capital control and the MCBDC bridge. So, I'm just wondering, is this MCBDC bridge just trying to mainly to solve the technical aspect of kind of exchange these CBDC cross-border institutional arrangements like capital control is separate, and the chapter also mentioned this FX conversion role. Will that sort of help, or maybe that's related to the capital control function?
Yes, Liwei, this is Hyun Sung Shin. The MCBDC proposals, and that it's a range of proposals. I mean, they're mainly technical. They raise mainly technical issues, and it's to explore the feasibility of connecting CBDC systems across countries. Of course, if you have a policy imperative on top of that, any technical arrangement will have to be consistent with the, with the technical, with the policy requirements will have to be accommodated in any kind of technical, system that's set up. There are lots of different ways of connecting CBDC systems across countries, across jurisdictions, and if you recall, we went into some detail in the chapter on how one might do that. The one that we favor is what we call the single CBDC system, where you have the CBDCs operating on the same platform, and that would include the FX conversion as part of the platform. I hope that answers your question.
Thank you, Hyun. And if there's any more questions, you're welcome also to follow up with us on those as well. So I think we've come to the end. There are no more questions. So I just want to thank everybody for your time today, for dialing in from around the world. I hope we've answered the questions, and we're at your disposal if there are any other follow-up questions over the coming days. A reminder that the embargo lifts at 2 p.m. Central European time tomorrow. And thank you very much, and goodbye from Basel.